Welcome to this explainer. Today we're going to take what usually feels like dry, intimidating accounting math and transform it into a highly dynamic business dashboard to really empower your decision-making. You see, managerial accounting doesn't have to be scary at all. Honestly, just think of it as the gauges, the dials, and the metrics you absolutely need to effectively drive your business forward. So let's dive right into this fascinating question. How do managers actually predict profit before selling a single unit? I mean, it sounds like magic, right? But it's actually pure mechanics. We're going to see how understanding the true inner workings of your business engine can help you spot inefficiencies and intelligently steer toward profitability. No guessing required. Here is our mental map for today. We'll be looking at 1. The foundation of business. 2. Preparing the final accounts. 3. Anatomy of a cost sheet. 4. Marginal costing and profitability. And 5. Standard costing material variances. Okay, starting off with section 1, the foundation of business. The engine block. You know how every vehicle needs an engine? Well, for a business, that engine is built on one universal, completely unbreakable rule, the fundamental accounting equation. Basically, what the business owns, its assets, must always perfectly equal what it owes to outsiders, its liabilities, plus the owner's invested capital. This is the ultimate balancing act of business finance. Every single transaction you will ever make relies entirely on this equation holding true. And this brings us to what's known as the dual aspect concept. Imagine your total business structure for a second. If you were to invest, say, 250,000 rupees into a brand new business, your asset account immediately goes up by that amount. But simultaneously, the business now owes you that capital, so its capital liability to the owner goes up by the exact same amount. It's like physics. Every action has an equal and opposite reaction. Moving on to section 2, preparing the final accounts, the rearview mirror. Once your operations are up and running, we have to look back in the rearview mirror at the end of the year to accurately assess our historical performance. And this builds in 3 distinct stages. First up is the trading account, which measures your direct buying and selling results to give us our gross profit. Second, the profit and loss account, which factors in all your operating expenses to reveal the true net profit. And finally, the balance sheet, which lists all assets and liabilities to give us a definitive snapshot of our overall financial position. But here is where we really need to pivot. It is absolutely crucial to understand that while financial accounting, the statements we literally just looked at, is a statutory requirement meant for external stakeholders like investors or regulators, cost accounting is an entirely different beast. Cost accounting is an internal tool. It's designed strictly for management to analyze, control, and actually improve operational efficiency. Basically, financial accounting tells the world how you did, cost accounting tells you how to do it better. Which brings us to section 3. Anatomy of a cost sheet, lifting the hood on operations. To truly understand where our money is going, we need to pop the hood and look directly at the cost sheet. This is a detailed statement generally prepared for the manufacturing of a single product. And notice how the costs kind of snowball as a product is manufactured. We start out with direct materials and direct labor, which combine to form your prime cost. Then you take that prime cost and add your factory overheads, stuff like machinery depreciation or power, to get your works cost. Finally, you take that works cost, add your office overheads, and boom, you find your total cost of production. It gives you this incredible, microscopic view of your spending. So cost sheets analyze the per-unit cost structure for various levels of production, acting as a complete information tool for management. Unlike the really broad strokes of a balance sheet, this highly detailed historical or estimated data lets a manager confidently bid for a new tender or precisely set selling prices. You aren't just guessing your margins anymore. You know them as a mathematical certainty. Let's shift gears to section 4, marginal costing and profitability, the predictive GPS. Now we are officially stepping away from historical records and into the dynamic, predictive tools that essentially act as your business's navigation system. The core of this entire system is the break-even point. It's the sales volume where a firm neither earns profit nor incurs a loss. Your total revenues perfectly equal your total expenses. According to accounting expert Charles T. Horngren, this is the critical point of zero profit and zero loss. It tells you exactly how much you absolutely must sell just to keep the lights on and keep the business breathing. Okay, so how do you actually calculate that magic break-even point? You just divide your fixed costs, like factory rent or manager salaries, by your contribution per unit. And what is contribution? Well, it's simply your selling price minus your variable costs. It is the exact amount of money each sold unit literally contributes toward paying off those fixed expenses. Building right on top of that is the PV ratio, or profit volume ratio, which is the relationship between contribution and sales. Listen, this ratio is an absolute corporate superpower. Why? Because it remains constant irrespective of your output level. If your PV ratio is 20%, it's showing you that every single 100 rupees of sales generates exactly 20 rupees of contribution towards your fixed expenses and your ultimate profit. It makes forecasting future profitability unbelievably simple. Now, looking at this, notice the gap between your break-even sales and your actual sales. That gap right there is your margin of safety. It indicates exactly how big of a revenue drop your business can survive before you fall below that break-even point and start taking actual losses. The wider that gap is, the safer your business is from unexpected market shocks. It's your ultimate safety cushion. Let's bring it home with Section 5, Standard Costing Material Variances, Spotting Inefficiencies. Our final dashboard tool allows you to instantly spot operational leaks. The Chartered Institute of Management Accountants, or CIMA, in London, defines a standard cost as a predetermined cost which is calculated from management standards of efficient operation and the relevant necessary expenditure. By strictly establishing these ideal conditions and costs before production even begins, managers have a rigid, undeniable baseline to measure their real-world performance against. So what happens when real-world performance deviates from that standard? Well, you get a variance. There are several specific types, including material cost, rate, usage, mix, and yield variances. Let's say your raw material prices suddenly spike, or maybe your factory uses way more steel than expected to manufacture a part. These specific material variances instantly alert you to the exact source of the profit leak. You don't have to sit around wondering why profits are down at the end of the month. The variance analysis tells you immediately where the friction is. By mastering these formulas, accounting completely shifts from dry academic math to a truly predictive toolkit for business survival. Think about it. We've built your entire business dashboard today. We started from the engine block of the fundamental equation, worked our way through the cost sheet, and stepped right into the predictive GPS of marginal costing and standard variances. So here is the big question I want to leave you with today. Which of these accounting dashboard tools are you going to implement first to drive your business's future profitability? I really hope this explainer has shown you the real-world power of managerial accounting, and I'll leave you to think about how mastering these specific numbers can fundamentally change your next big business decision. Keep learning, and I'll see you next time.